Hello everyone, welcome back to Nandu's Equity. Indian economy has been going quite strong and the large caps in India also growing strong. What if you could uncover hidden gems among India's largest companies? Today I'll show you how to find undervalued large cap stocks using a simple screener formula that could help your portfolio. In India, any company having a market cap more than 20,000 crore is a large cap. And in fact, some people call companies that are having more than 1 lakh crores as mega large cap. For simplicity, we will call large cap for any companies that are above 20,000 crores. Selecting a good large cap stock requires some key criteria for long-term investing. It should have industry leadership, or it could be a moat or monopoly with strong financials, key return metrics, dividends if possible, and also when we buy it should be a value buy, definitely mispriced or cheaper in the market, and should also have growth prospects, good governance, ethics, and also we need to check its industry and market trends. Similarly, we want to avoid large caps that are having some red flags like high debts, poor promoter holding or poor promoter pledging, and also declining market share or margins, regulatory or legal issues, and also over dependence on single customer or supplier or very specific geographic locations. With all this in place, I have made a simple query: market cap more than 20,000 crores and P ratio less than industry PE, and of course if it is less than 25 will be good, and PEG ratio above 0 and below 1 so that we get a clear entry point. And of course EPS, ROE, ROC all above 10, and also we want to look for 5 years average return more than 10 and dividend yield more than 0. From this filtered formula list, we got Coal India as a number 1 stock with very strong fundamentals, and it's a favorite stock for many investors, long-term investors, as it is currently available quite cheaper below 400 from its all-time high of 540 plus levels. And definitely looking at its P ratio, PEG ratio, it looks quite lucrative. And of course, look at its intrinsic value, almost having a double of it current price. And EPS, ROE, ROC all looks quite strong. Our next stock is ONGC. Again, it's a PSU, currently available quite cheaper below 260 level, and its all-time high is 345. And P ratio is quite cheaper compared to industry PE. PEG ratio is also looking very interesting, and of course EPS, ROE, ROC all are good. Intrinsic values higher than current price. Both Coal India and ONGC are well known for its dividend yield. I think Coal India giving more than 6 dividend yield and ONGC is close to 5. The third stock is Oil India. Again available quite cheaper. From last year itself it has already had doubled and it has come down now in price. P ratio, PEG ratio both are cheaper, having a very strong intrinsic value, almost 3 times or more than 3 times of its current price, and EPS, ROE, ROC all are interesting. Why Oil India? So Oil India is one of the few companies that are into the upstream of oil production. So what is upstream? So upstream means exploration, digging, and exploring the oil. And midstream means transportation and reaching out to wholesalers. And downstream means it is oil marketing companies like Indian Oil, BPCL, HPCL, which are kind of selling the final product like petrol and diesel. So in the upstream, only very few companies are in India, and this is again a PSU. So this looks very interesting. The fourth stock in our list is Rural Electrification Corporation Limited, REC simply. And it is also beaten down in the recent crashes and available at below 540 level and with all-time high of 654, and of course with a very strong EPS at 56, ROE, ROC all are good, and also intrinsic value is higher than current price and definitely available cheaper from P ratio at 9.5, PEG ratio at 0.48. Fifth stock is OMC BPCL, and among all the other OMCs, this is available cheaper below 300 level, and by P and PEG ratio, I mean it is cheaper. Otherwise IOCL is cheaper in its price perspective. and by valuation this is cheaper among all of them, and available with very lucrative EPS, ROE and ROCE. The sixth large cap in our list is Hindalco, well known for its moat level in terms of production of copper as well as aluminium. So definitely an interesting stock, currently available quite cheaper at below 590 levels, and of course with a very strong EPS and ROE, ROC and intrinsic value. P ratio is quite cheap at 10 compared to industry P about 28, and PEG ratio is also giving a very clear entry level. The seventh stock is Nadco Pharma. I generally do not discuss much of the pharma companies, but this time the way pharma industry itself is reviving and just started picking up now. And of course we should always be very careful with pharma companies, as the US FDA, whenever they come up with some observations from their audit, definitely these companies go down. But of course Nadco Pharma having some very specific patents and APIs, and also a lot of generic as well as specialty pharmas, currently available at below 1400 level with its very good PE at 12.5 and PEG ratio 0.74, and of course with very strong EPS, ROE and ROCE. Recently the NBFCs came down, and Chola Financial is one of them, currently available almost 600 rupees less than its all-time high, so at 1500 levels, and its P ratio has come down at 14, PEG ratio 0.7, about 0.7, and with strong ROE, ROCE, EPS and intrinsic value. The next one in our list is also an NBFC, Shriram Finance, currently available almost 600 rupees less than its all-time high, and of course with very strong EPS, ROE and ROCE, and it is also having a decent book value and intrinsic value. P ratio, PEG ratio looks quite interesting. The last company in our large cap list which are undervalued is Dr. Reddy's Labs. It's kind of definitely closer to its all-time high and 52-week high, and of course however the P ratio looks very lucrative and PEG ratio also below 1, and of course which has a strong EPS, ROE, ROC, intrinsic value. So this one has a very good market share and also a lot of generic formulations. So this company currently available cheaper and very interesting from the large cap undervalued stocks to me. You might ask me why I did not discuss about LIC. LIC currently definitely available cheaper from both PE and PEG ratio perspective. PEG ratio in fact looks very lucrative, and of course all fundamentals are quite strong. The only reason is LIC is having about 6,500 crores of its investment in Adani group of companies, and Adani group of companies are going through some litigation and allegations in the US. So I want to get more clarity, because if anything comes as a bad news, FIIs will try to crash this particular area. So that's why I want to be very careful. Thanks for watching. Hope this video is useful to you. If so, please click the like button, and if you have not subscribed, subscribe, and also share your feedback in the comment section. Thank you.